An economic calendar is one of the most powerful tools at your disposal as a trader. It provides a scheduled snapshot of economic events that can significantly move markets, but the real skill lies in knowing how to prioritise and interpret this information effectively. First, let's talk about prioritization. All economic data isn't created equal. Inflation measures, for example, carry different market impacts. CPI, the Consumer Price Index, usually holds more weight than PPI or the Producer Price Index because CPI directly reflects consumer-level inflation and heavily influences central bank policies. Similarly, in employment data, the US non-farm payroll, NFP, carries greater importance compared to the ADP employment report. And that's because the NFP is an official government statistic that the Federal Reserve closely monitors when making policy decisions, often triggering larger and more sustained market reactions. When it comes to central bank-related news, the hierarchy is clear. Official meetings like the Fed's FOMC rate decision have far more influence than individual speeches or commentary from Fed officials. Whilst these speeches, often referred to as Fed speak, can cause intraday volatility, actual rate decisions or policy statements have more substantial and longer-lasting impacts. Another critical skill is effectively comparing market expectations versus actual reported figures. Before a key release, analysts set consensus expectations. When actual data significantly diverges from these forecasts, we see increased volatility. For example, if the market expects US CPI to rise by 0.3% month over month, but the actual number comes in at 0.6%, markets will likely react sharply due to recalibrating inflation expectations and thus the likelihood of future central bank action. Finally, consider tracking economic surprise indexes. These indexes quantify how economic data releases are performing relative to expectation. A rising economic surprise index means data is consistently better than expected, typically boosting sentiment in equities and strengthening currencies. A declining index can indicate weakening fundamentals, signaling caution or even opportunities to short overextended assets. In summary, knowing how to read an economic calendar means mastering the art of prioritization and comparison. By focusing on CPI over PPI, NFP over ADP, and official FOMC decisions over general Fed speak, and carefully monitoring expectations against actual data, you'll be better equipped to anticipate market moves and refine your trading strategy.